Welcome to Financial Literacy for Not-for-Profit Directors. In this video, we will examine the cash flow statement. The cash flow statement is also known as the statement of cash flows. The cash flow statement identifies how the organisation's cash has been generated through the year and how the cash has been used. Reported in the three categories of operating, investing and financing, it provides a better breakdown of the cash and an easy way to assess what area of the business generates or uses the cash. What is cash? Cash includes cash at bank, on hand and in transit, cash equivalents or short-term money market facilities. If there is no sustainable operating cash flow, sooner or later the business will fail. If debts cannot be met as and when they fall due, risk of being declared insolvent. Cash shortfalls need managing. Cash flows from operating activities. This section of the cash flow statement records the cash inflows and outflows generated by the operation of the business. It includes receipts from customers, payments to suppliers and employees, interest received and paid, and income taxes paid. When you are reviewing the cash flows from operating activities, you should consider the following. The net cash flows from operating activities is considered the most important cash flow to monitor and should be a positive number for an established business. A positive number shows that the operation of the business is generating cash that is surplus to operating requirements. Indicators of lack of sufficient generation of operating cash flow that may lead to solvency issues are: net operating cash flows are negative, cash receipts from customers are less than cash payments to suppliers and employees, net operating cash flow is not sufficient to cover the purchases of property, plant and equipment. The figures on the cash flow statement will not be the same as those on the P&L or income statement due to accrual adjustments, timing differences and GST being included in the cash flow statement figures. Cash flows from investing activities. This section of the cash flow statement records the cash inflows and outflows generated by investing activities, which includes the buying and selling of the entity's plant, property and equipment and its investments. When you review this section of the cash flow statement, you should consider that if an organisation is investing in its property and plant and equipment, this will show as a negative number. Often, if an organisation is cash-strapped, it will slow down in replacing its asset base. It is useful to assess the trend over a number of years. Also assess if the organisation is putting cash into investments. If an organisation is selling their plant, property and equipment, it'll be a positive cash flow. The cash flows from financing activities records the cash inflows and outflows generated by financing. It includes the buying and selling of an organisation's shares and movements in borrowings. When reviewing the cash flow statement, the following questions should be asked. Has the cash flow statement been reconciled to cash and cash equivalents in the balance sheet? Is the net cash from operating activities generating a surplus? Is the organisation self-generating? Is the cash from operating activities greater than the net profit after tax reported on the income statement? If net operating cash flow is negative, how has the business sourced cash? That is, has it sold assets or increased borrowings? Thank you for watching this video on the cash flow statement.